So the previous discussion talked a lot about big ambitions, but perhaps without the financing in place, it's difficult to achieve those ambitions. And the four of you come from very different parts of the financing world. Perhaps to start with you, Bill, from the VC side, you're perhaps at the very early stage when it comes to a lot of these ambitious projects, and maybe you can set the scene from your perspective.
Okay, thank you very much, ladies and gentlemen. As Mustafa mentioned, we are a venture capital company, and we are early stage venture capital company, which means that we look at companies at the very earliest stages of its development, seed and on. So we look for opportunities where we believe the entrepreneur has an interesting idea, some basis of a technology in an interesting big market. If you can combine those things, market, idea, team, with a little bit of our capital, we believe we can take it to the next level, then raise additional funding at a higher valuation. And then at a certain point, we start to run out of money that venture capitalists can provide. And we turn to our colleagues sitting to my right, and we hope that project financing and other types of more traditional funding will be available for companies that started out life as ideas somewhere in a garage in Silicon Valley.
And some of these projects are obviously quite exciting. You're involved, for example, in Hyperloop or Uber. They're very disruptive. At what point do the more traditional financiers get excited about these projects? Where do you have to get them to before they start taking your calls?
Well, as investment bankers, I think they're pretty active very early on because they want to help do more of the public exits. So from that perspective, the banks are very excited, and they watch the investment community very closely. So I believe there is a dialogue very early on with exciting companies. So I think the investment bankers were quite all over already. Our companies at Hyperloop, they're already talking to us. At Diamond Foundry, bankers are talking to us about possible funding and possible exit at some point. So there is dialogue happening. Different areas of financing world start talking to us very early.
Roberto, you're head of disruptive technologies at Deutsche Bank. So you're kind of from the outside inside. How does that work?
Yeah, well, the title inevitably is particularly peculiar and unusual, I would say, in the financial industry to be the head of disruptive technology and solution. But within the organization, we decided on purpose to have this kind of title and this kind of structure, because the purpose is not to scare the internal functions, but try to explain how these technologies, which I wouldn't even call them anymore disruptive, I call them exponential, are necessary to be embraced, because they have to help us to change the model, the traditional model of banking business. Primarily, we are focusing on artificial intelligence, on blockchain, on Internet of Things, on RPA, some topics that until a few years ago seemed to be very far away from the financial environment. But nowadays, we recognize that the technology, it definitely needs to help us to change completely the way that we process, the way we define the products, the way we create user experience, and inevitably this is something that will change the scenario. The question is not today, should we do it or not, but the question is how fast the bank are willing to embrace the technological changes. And there are already many scenarios that we have seen in these days already how the traditional heavily regulated industries, be it the airlines, the automotive, the medical, they are all, of course, embracing the technology, especially artificial intelligence, in a manner that was not even foreseeable before. I think today we live in an area where fintechs and the competition is helping and is pushing the banks to compete, to technologically be advanced, to change completely the business model that we had before in order to try to fight the possible erosion of revenues because of margins shrinking, but also because some of these revenues are inevitably going to competitors.
So we have different forces at work. We have the VC guys who are finding these good ideas and turning them into reality. There are the needs within the banking institution itself to meet the changing landscape going on outside. But then we have the overall, it seems like, has trade changed at all? I mean, your corporate clients, Baihas, are they doing anything differently? Are they being affected by all these other factors that are going on?
So the funny piece for me, Mustafa, would be the fact that our corporate client supply chain have changed dramatically. And I'm going to use disruption, Roberto, with your permission, to describe how the supply chain disruption has happened. Most of the people are talking about their iPhones, about their smart tablets. If you look at the source of the components of those of those gadgets, they are procured in 20, 30, 40 countries. And that means that any corporate has 40, 50 suppliers sitting in 40, 50 destinations. How you can fulfill, how you can deliver financing to those suppliers to accelerate the cash flow, to allow them to produce more, to be more efficient. The funny piece for me is comparing retail banking and corporate banking. Look at all of us. When you look at your wallet, you can pay everything, instantaneously, through your mobile phone as a retail client. You have immediate payments, immediate, reactions. You go to your website, you buy something, and you get it paid immediately. All that has developed very well on the retail banking side. Unfortunately, and I'm going to be the challenging guy here, the corporate bank, innovation did not happen that much and at the same speed. And I agree with Roberto, disruption is maybe not the right word at this point in time because of the developments. We at Barclays, we have decided to embrace this, innovation agenda into the corporate space by way of, putting accelerator programs, in New York, Mumbai, South Africa, London, Hong Kong, and bring all these fintechs together to sit down, listen to them, support them during the process of building their concept and making their dream a reality. And by the way, we will get some benefit out of it because they are building the solutions, the technological solutions that we need as bankers to unlock, the cash flow, the capital cash, the working capital that the companies need.
It seems though there's not enough of attention. I mean, the three of you are here and you're all saying similar things, you're all working together, but that can't be the actuality. There has to be a lot of competition going on. Someone's eating someone's lunch here, and who would it be? Is it, who are the main people?
For sure, maybe I can just add a quick point. That's why I was making reference before to competition. I'm particularly pleased that there is this competition. I'm pleased that there are fintechs that are bringing verticals that compete with us, right? Because inevitably that will force us to change, right? In the corporate environment, it's true. I mean, the banks have been sitting for quite a long time thinking that our market share will never be eroded, right? And this is no longer the game. And this is forcing us to create digital structures within the banks, to create digital offices within the banks. It's forcing us also to identify potential partnership with startups that maybe we don't think they're necessarily the next IPO, but they can be also provider of solutions together with us in order to try to create a service which is completely different and not even conceivable before. And in this respect, of course, it's a complete game changer. And it's not really going to change in the long run, but it will change really in the fast run, right? And that's why if you think about the blockchain, the IoT, I mean, let's face it, logistic companies, for example, talking about supply chains, they already have heavily invested in IoT and they have a full track of the merchandise from the moment it's produced until the moment it's shipped, right? And I think we'll have probably an input from you, a valuable one, but just provocatively, because before I let him know. Behind any supply chain, there is a supply chain financing. And for me, it's inconceivable that the logistic companies, the insurance companies, are able now to track firmly any single moment, any single step of that trade, and the trade finance has not been able yet to provide solutions comparable. And we're working in that respect, and I think blockchain and IoT together is definitely something that the banks will embrace fast and will bring solutions that we haven't seen before.
Sriram, I'll bring you in at this point. Quite nicely done by Roberto. This is exactly what you're doing. You're looking at the supply chain and identifying the opportunities.
That's right. Today we have a foundational technology called the blockchain, and it allows us to do something that was not possible till today in human history. It allows us to do title transfer. Think of a bill of lading. It's been around since the days of Christopher Columbus, and it still is a paper-based product. And that essentially is how title gets transferred when you ship goods across the oceans. Think of letters of credit. That's typically how banks essentially provide payment guarantees to sellers based upon the buyer's credit. What the blockchain allows us to do is to create a new form of transaction that can be secure and transparently so to all members of a supply chain ecosystem. What we at Skuchain have done is leverage this technology to allow for what we call collaborative commerce. Think of 1995 and how the internet gave birth to e-commerce and Amazon gave it structure, and we now have pay with PayPal. Today there is a blockchain that's giving birth to what we call collaborative commerce, and we're giving it structure. And you can now trade with Skuchain. All aspects of a trade can be governed, from the order to the shipment to the invoice to the payment. And when I'm purchasing from my tier one, think of the aerospace supply chain. You have tier one purchases raw material from tier two or tier three. Today, there is an information asymmetry. You've heard of Industry 4.0. That's where information replaces capital. And that information sits on a blockchain ledger in a way in which all parties can trust it. If you think of how this technology can be foundational, you can begin to recognize how you can have essentially a barrel of crude oil in Abu Dhabi that you get plastic granulate from, that turns into a key that goes on a keyboard, that goes on that Mac computer that you buy in a retail store. And when you click on that letter A, you can sort of tell it which barrel of crude from Abu Dhabi it came from. That's the kind of provenance trail that we're talking about, being able to sort of prove, farm to fork, grape to glass. And information essentially is the money that transfers across different parties in the supply chain. And what we're able to do is to tap the credit quality of the governments and the large anchor buyers and use that to provide working capital relief. We can go into more detail about how all of this happens, but sitting in Abu Dhabi, which is, as the previous panelists talked about, they are sprinting to the future. You can begin to see how this is going to become the foundation for a lot of the global supply chains.
Baihas, I mean, is there room in that vision for you?
Well,
and the other banks?
Definitely. Just to reinforce, Sriram's view, we are, in Barclays, we are using, a different platform. And using blockchain has been able to accelerate the letter of credit processing from an average 15, 20 days between two banks into making it for, executed and paid in less than 4 hours. Can you imagine 15, 20 days reduced to less than 4 hours? And by the way, could be even reduced to less than an hour once all the banks do embrace, this technology that Sriram is talking about it. So it's the opportunity is there, but you have to start thinking about the industry adoption. Because at the end of the day, UAE is a great example of a focused government, as His Highness said before, and blockchain is, it's a target for them. So it's funny, the development on that side might not be coming from the West for the first time in life, and might be coming from the Middle East.
Well, you're almost finance agnostic, I think, where you are, and so perhaps your perspective is almost as the most honest broker in the room. When you're listening to your fellow panelists, what are the views that you're coming up with?
Well, people have been predicting the demise of banks for a long time. The banks are still with us, although some 500-year-old institutions in your native country may go away soon. But nevertheless, I think banking in some shape, way, or form is going to be around. Who's going to backstop it? Or the government's going to be involved? They're going to have to step in continuously and prevent the bigger banks from failing. I don't know. But there will be some sort of financial institutions that will have to be in place. The question is, at what stage do these banks get involved in financing entrepreneurs and guys who are starting out? Probably they're not set up to do so unless they have specialized arms who have different mandates. So there is an opportunity for other players to come in and do a little bit of that, whether it's venture capital, private equity, some growth capital. So I think there is opportunity for banks to evolve, to stay involved, to be part of that transactional process and trade process, as the previous speakers have mentioned. But I think there is a tremendous opportunity for technology to help the banks survive and become more profitable. So recently we've been speaking to Mr. Greff, who's a very forward thinker at Sberbank, Russia's largest financial institution, and he's worried about the fact that his clients are going to go away. The borrowers are going to change. He thinks they're going to be disintermediated. He's not worried about the bank himself yet. He's worried about his clients are going to borrow less because they're not going to be there. So he wants to stay and help the borrowers become more technologically savvy to survive and prevent the onslaught of these new kind of little guys who are eating his clients. So that's an interesting kind of approach to banking. But also helping banks achieve profitability. As I said, we're working with a couple of institutions with one of our startups that's helping automate the call centers. It's, it has obviously two sides to the coin. On one hand, we're improving the way the customers get service at the call centers, and we're providing very innovative technology based upon artificial intelligence and natural language processing to be very helpful. So we're working with very large financial institutions, not represented here, unfortunately, at this juncture yet. But we're helping them reduce the cost of having that call center. At the same time, obviously, there's going to be job losses as well attached to that. So we understand that technology will have very dramatic implications for the bottom lines of financial institutions, but also has some societal costs and benefits that will be attached to that. So we're hopeful the banks are going to be around, and we're hopeful they'll be partners and clients of ours going forward.
Roberto, as I said, you're sitting there in your particular role, and you must be hearing this all the time, these conversations about the future and how financing is developing and how what are clients' worries. And it must fall to you to kind of come up with solutions that diminish a little bit of that concern.
It's difficult to strike the right balance, no doubt about it. I guess we are in this forum also thinking about the consequences that technology has, not only in the manufacturing industry, but also in the service industries like the financial one. It's inevitable. We have heard in the last few days the impact of artificial intelligence, the replacement of human beings with robotic. For sure, unfortunately, or fortunately, it depends from point of view, some improvement in technology will imply also changes of the roles and responsibilities as we have seen until today, right? If you think of all categories, Reuters, for example, today uses artificial intelligence in order to spot some fake tweeters, right? Sloan Memorial Hospital in the United States uses artificial intelligence, Watson, in order to try to help doctors to prevent or identify possible diseases in the cancer area. Banks are using artificial intelligence in order to detect maybe fraud in possible high-speed trading, or to help the call center, or to empower private bankers or corporate bankers to have the right solution. And this is the usage of artificial intelligence, or examples of use of artificial intelligence to empower the human being, not to replace the human being, right? It's inconceivable today to imagine a private banker has the complete knowledge of all the thousands of bonds and funds and stocks in order to provide the right advice to the client based on his inclination and propensity to risk. But if you have artificial intelligence helping to reset completely the portfolio, then you provide the best next action to the client, right? On the other hand, thinking about different changes which have an impact on society, true. If you read, there are insurance companies that are thinking of replacing actuaries with artificial intelligence, right? Theoretically, banks could replace analysts going forward, because those analyst reports can be produced automatically, right? Like the same way that I think if you read recently, there was an article on Wired, an example of an entire article written by artificial intelligence. So sorry for you, bad news, but also journalists are at risk. So how do we deal with that? I think any industrial revolution or digital revolution like this one, it will have impact, but it also creates new jobs. What you need for sure are the so-called subject matter experts, I call them, right? Even within my organization, I always mention we need to help people that have a knowledge in what particular sector, being trade finance, corporate banking, private banking. You need to move them from being the people operationally completing the transactions to the people that become curator of the information, or to train artificial intelligence to give you back the proper answer. And if you think about, I don't know, cybersecurity, they estimated in the next 3 years there will be 1.5 million jobs needed in cybersecurity. Right? So those are new jobs that did not even existed 3 years ago. So all these changes completely.
Everything you're saying it makes sense, except that we need human beings because we don't live in an information perfect world. Yeah. So, it comes back to this of how technology is going to create an information perfect world. I mean, an AI program or a robot can only make decisions if it has access to all that information. But as we know, trade, business, it's not always that transparent. So at what pace will the opening up of information, the increase in transparency go at, and then at what pace will these jobs be replaced? I think they go hand in hand.
Well, happy to jump here. It's funny, but we, with the banking hut, are so used to hide and keep behind walls, all the information we've had. Our industry has been built on the basis of, let's keep it for myself. Let's avoid Roberto in Deutsche, looking at what I'm doing in Barclays. This has been the history. But when you listen to Sriram about, blockchain is about sharing the information. And there is common benefit for this, because sharing the information is gonna kill all the frauds, gonna give visibility, transparency to the market. It's gonna help not only accelerating the cash flow that I alluded to, it's gonna help also the banks, the buyers, and the sellers to have full visibility on the transaction. And that is gonna easy life, gonna accelerate cash flows, but gonna help also the banks, to your point, Bill, of having more appetite to finance more the industry and the manufacturing, because you have all the information available. What else you need to unlock the money?
Is that true? Will we get access to all that information?
So let's talk about the Internet of Things, right? You've got thousands and thousands of sensors, and they're all sending out these bits of information, but how do you make that actionable? You have to have this information be trusted. So think of the Internet of Trusted Things. Think of a humidity sensor in a cargo container that hits a threshold, and a penalty has to be sort of attached to the transaction. The transaction happens at a different spot from where the actual sensor was. So you've got to share that information. Without it being shared in a secure and trusted manner, you can't act on it. So at Skuchain, we have actually co-chaired a IoT blockchain consortium with Cisco and Foxconn and Gemalto are some of the founding members. And what we're building is a framework for being able to sort of collect these sensor signals from all of these, the petabytes of data from a jet engine, if you will, and turn them into actionable signals. So going back to the robot, for the robot to take action, you need to have a trusted signal. So the world is coming. It's not happening tomorrow. I don't think human beings are going to be replaced. But I think it's an evolutionary process. But technology is coming in a way in which it's going to be actionable.
And Bill, does that mean, is an information perfect world something that scares you and your VC colleagues in Silicon Valley? Does it inhibit your ability to operate and make deals and find the next big idea?
I think in general, I mean, asymmetry of information, we talk about sharing, and sometimes there's a limit to that, obviously. But a lot of venture deals are obviously club deals. A lot of deals we come in, we don't take the whole deal ourselves. We usually follow or we co-invest along with somebody else because we don't have all information and we need to share and understand and figure out how to best apply it, and other people may have the best application in mind than we do. We come from a particular background. Our investors are transport and logistics people, so we happen to be heavy investors in that sector. But we don't necessarily know everything about blockchain, and we'd love to partner with people who can apply blockchain technology as we develop in an offline business, kind of the 5PL approach to partnering and delivering product from a Renault factory or a Toyota factory to a dealership or actually somebody's house in the Valley or in Moscow. So for us, partnership is integral, and we'd love to figure out ways to identify those partners in those sectors who can help us understand the process, be part of the process, and help us enjoy the success together going forward.
So let's assume that the financing is in place for the project, whether it's mass transport or something else. How is technology disrupting the ability to kind of make money on that? How is it changing the business model so to ensure that the risk is secure, that the money that is lent will be paid back? I mean, are you having conversations at the moment, whether within the banks or in Silicon Valley, on the sort of disruption that's going on in that area?
I don't know if it's a question to me. I can try, sorry. I can try to start. As every banker will probably know, project financing is all about figuring out who's best carries what portion of the risk, and kind of apportioning that situation as best. We take upon ourselves very early stage risk, the execution risk, the stuff works, that Hyperloop is going to be able to shoot a pod carrying 2 containers through a tube at a certain speed and get it there safely.
Sounds crazy.
Yeah, if I told you you're going to sit in the can in aluminum 10,000 meters above the earth, hurtling at 1,000 kilometers 100 years ago, you'd say the same thing. So we take that risk. That's the Kitty Hawk risk. We take that risk. We're probably not well positioned, nor are we capitalized enough to take the scalability of that. So when we decide together with the government of Dubai, for example, or Abu Dhabi, to link Dubai and Abu Dhabi with a hyperlink tube, probably other institutions will need to be involved.
Yeah, because the government doesn't want to take on all the risk, and you certainly at some point have to.
We can't, right.
Can't. And then how do you sit in the middle of that? Do you sit in the middle of that? The bank.
It's inevitable, like as you mentioned, in any project financing, inevitably you have the governments, you have the private investors, and then you have financial institutions. It all boils down to the quality of the project first, to the sponsors, to the stakeholders, right, to the reliability also, the technology providers. So like any project, can be a startup, can be a fintech, can be a massive project like the Hyperloop. I mean, the first key question is the reliability of the components and the players. This is inevitable, right?
And this is where the blockchain may come in, where it ensures the reliability or the provenance.
But blockchain is a pipeline, I would say. I don't want to diminish, because I'm sure maybe you have a different opinion, but I would say we have built, in the last few years, we have seen the build of the pipeline, right? Or the analogy you probably hear many times, blockchain is like the HTTP protocol that was created decades ago that then hosted the internet. So the goal is to have the blockchain, the pipeline that will help several transactions specifically for trade finance, but also in all capital market settling and the clearing of securities, which will help to create a speed and eliminate a lot of redundancies. But now we are assisting for the first time, I guess after years of experiment and building the pipelines, we are assisting also to products and services which are going to be launched in the market, right? I mean, there are lots of consortium, a lot of ideas. We are part of a DTC consortium, so-called Digital Trade Chain in Europe, with 7 banks covering 9 countries. And this is the first time in 2017 you will see a platform which will be hosted by 7 banks. But again, this will not be limited to the 7 banks. The 7 banks have decided to put the forces together, put the energy together, the capital together to develop something, and then will open immediately to the other European banks. It doesn't want to be a club deal. On the contrary, it wants to facilitate the speed, create the knowledge, and then embrace many more banks in Europe and in the other continents. So I guess now we are really moving from the proof of concept to the user case to delivery of solutions. Some of them, like Hyperloop, maybe it takes longer because the project, of course, is necessary. But I guess there is more and more competence and confidence built and willingness to finance.
I mean, if we follow this train of logic and it's successful and this is the norm, and at some point it has to be securitized and you know, mum and pop has to eventually own it. But to paraphrase Warren Buffett about sort of weapons of financial mass destruction and complexity and all of that, I mean, the average person wouldn't be able to tell you what the blockchain is. And so if eventually they are investing in products or taking on risk because it's being securitized related to that, how does that not create an even more difficult situation where you guys can, not you specifically, but the industry can take advantage of that?
So maybe I'll address it differently. Think of a light switch, on and off. It's very simple, except it's the foundation of all of computing as we know it. The blockchain is foundational. It does things that you could not do before. And that's really important. We underestimate the magnitude of this kind of change. I'll give you an example. We talked about additive manufacturing. Think about 3 people each coming up with a specific sort of computer-aided design, and all of those things coming together to form a final product that you can print maybe in your kitchen. And now all of them have to get paid. So if you go back to the securitization of collateralizing assets, collateralizing IP, you begin to recognize how the blockchain, although it could be looked at as merely a pipeline, just as a light switch can be looked at as merely an on and off thingy, it effectively creates this baseline on which you can sort of create fairly complex, highly sophisticated, ultra-modern applications. And that's what Silicon Valley is doing with the blockchain, and it's like the supernova, right? From healthcare to insurance to reinsurance to the letters of credit to supply chain to track and trace to additive manufacturing. I mean, you're just beginning to see a massive, massive explosion of innovation around it. And you've just started.
Mustafa, if I can jump into this as well, it's funny because the consumer behavior pattern, the buying behaviors, have changed. And that is a fundamental disruption of the way we have been operating. Let me bring this to life. When you know, each of us every morning go and buy a Starbucks coffee. And for us, Starbucks is just, you know, a coffee provider and a healthy food provider. In the reality, Starbucks started like that. But today, Starbucks is one of the top 10 banks in the US in terms of retail deposits. Why is that? Because of the prepaid card. It's so funny that a coffee shop has become suddenly a bank. And this is a fundamental change in the way we were operating. The patterns, the behavior, when I was a kid, first time I went to a Starbucks in New York, it was like, you know, you have to queue, you know, 2 minutes to get your coffee. Today you can just, through an app, you can order that coffee with a prepaid, balance in your phone. And you know, while you are getting out of the tube, you just order your coffee, and then you pass through a machine, you grab your coffee, and keep going. It's a fraction of seconds, while it was 3 minutes queuing. That has created a different need, a different business model, a different requirement. So that needed, you know, Starbucks to build their ability to create the prepaid cards and embed that into an app and create a cash business. That is a different business. Domino's Pizza today do consider themselves as a technological company. The underlying pizza that we all eat is just an accident today in the process. So it's just look at how all that have changed. So there is, you know, we human beings, and we are talking about robotics, we are defining very much the new era, the new way of doing business, and the new way, you know, financing is going to be operated going forward. Going to your early question about competition. Today, I'm not competing with Roberto. I'm competing with fintechs that has better technology, better understanding, more agile, and being able to adapt very quickly to payment and to consumer behaviors that are changing the way funding is being circulated, money is being, you know, going around.
I started the panel very excited about the future of financing. Now I'm terrified because
You should.
I'm having a coffee and I'm creating a bank, and there are fintechs doing all this kind of stuff. I mean, who's protecting us? You know, who's out there kind of making sure that none of this gets out of hand?
Well, it's a good point. I mean, of course, and I guess this is where the banks come in place and the regulators come in place to ensure that whatever kind of financial solutions is provided or services provided to the end user, it respects also the regulation and protection, which is absolutely adamant. And this is where I believe fintech, as you said, you can compete, but you can also bring them on board, and you can, at this point, make them as a partner, because you as a bank have the infrastructure, you have the knowledge regulator, you have all the compliance in place, you have all the anti-money laundering in place, the KYC, all the regulatory framework is there, but you can help some of these fintechs to be a technology provider and solution provider within a regulated framework. Of course, we have to onboard also the regulators as much as possible in order to facilitate this evolution going forward. But this is one of the main aspects that you have to follow.
It's worth, you know, just for a moment, just thinking about that, because we've talked about governments being very ambitious. Governments come on as partners, whether it's for financing technologies or other ideas, and then we have the fintech at that level, and the regulators are helping them. The banks are involved now, and you have, you know, companies like yours involved in developing the technology. But we don't have a sort of independent, neutral party that steps back and says, okay, how is all of this being handled? Everybody's got skin in the game. And when that's the case, then sometimes we don't stop to ask, is this right? Is this the way forward? We get a bit ahead of ourselves.
Maybe I'll start just a quick...
I think that's par for the course. I mean, life is messy, and we're going to make mistakes, and regulators don't have the answers all the times, and, you know, governments, nor they do. You know, so it's okay. I think it's okay to make mistakes. It's okay to fail. It's okay to go down a blind alley, turn around, and do something else and pivot, as somebody was mentioning. I don't think you should be nervous. I think we're at a very exciting place as far as humanity is concerned, in my opinion. I think it's great that a coffee shop can be a bank. Makes the banks work harder for your money, I think. So I'm happy.
One thing that for sure, I guess, we will see going forward, and this is a fundamental demographic change that we have to face. And that's what, at the beginning, when I say we have to change the business model, because the business model we have today, let's face it, is no longer sustainable for any bank, right? You cannot imagine the banks that have a 70 to 80% cost-income ratio with this kind of disintermediation, new entrants, new competitors, is able to sustain the same cost-income ratio in the next 5 years, right? And therefore, you have to change constantly. You have to rapidly adapt to something that was not even conceivable. Also because clients, especially the new demographic generation of clients, don't have anymore something that we were capitalizing on all the time, the sense of loyalty, right? Our business model was based on the fact normally the client was loyal, probably for the entire lifetime with the bank. They most likely had a 2 or 3 or 4 products, right? Our business model was one based on, let's try to launch a product, make sure that we attract the customer with one product, and probably will make more money with the so-called cross-sell ratio. That was the main KPI you will probably still find in some banks. Well, if loyalty is no longer a component, that KPI is dead. Fundamentally, the unit sales, the cross-sell ratio, the traditional KPIs that we were basing our fundamental business model will no longer be reliable. You need to be able to embrace the client on service providers, not only more on product providers. And this is where the kind of trust between the financial institution and the bank has to be totally re-engineered, because maybe the client will have an account solution with one fintech provider, a P2P lending with somebody else, asset management with another fintech provider, and maybe uses the bank as an aggregator of all these solutions. And then you provide a service, not anymore a product. And that's a fundamental revolution of the business model.
It's interesting you say that. I mean, how much, so much of financing has been about relationships in the past. And will that still be the case going forward? Will that matter? I mean, I'm not talking about basic name lending, but, how much is it about a kind of relationship between a client and the people raising the money for them?
I think the advantage of new technology is that you don't have to be dependent on relationships. So there's a lot of agility. You could work with a person 3,000 miles away across the globe without having had a previous relationship with that particular supplier. And you could have multiple suppliers all participate in an ad hoc manner with each other, because there's this technology called the blockchain that allows them to sort of work with each other securely. So relationships were, I think, how investments and things started. But I think we're moving to at least manufacturing future, where it's not relationship-centric, but it's data-centric. It's based upon your actual performance, and that performance can be quantified and securely understood and actionable.
And if it becomes more about performance, then do we potentially miss out on people who make mistakes at the beginning and then get things right? I mean, as you said, life is messy, things aren't smooth. If somebody's track record is a bit bumpy, they're going to be penalized?
So that's why we have venture capitalists, for example, to help in that early stage process. That's why we have social networks to help provide different forms of reputation. WeChat, for example, provides credit to people who give gifts to each other. So there are different ways of computing that same bits of information. And we understand that there is risk in the early days, in the trial and error. So it doesn't go into formulating a reputation score, and you actually work through early stage venture capitalists who are happy to take that risk, because in their arithmetic, they work with 10 startups and 2 make them and return the fund, and the other 8 may go bust.
And to what extent is technology creating a kind of new finance? I mean, we had conventional finance, Islamic finance is an offshoot, we have different types, and if something is based on that transparency, the blockchain, all the things we discussed today, is it almost like a brand new area that will grow and potentially overtake everything?
I think that this is a flow that we will have to accept. It's inevitable. Again, going back, to my example about Starbucks, you can find in Europe, in the US, in LATAM, more and more people buying online, and as they don't go to a shop, they just buy it online, and you have such a facility in terms of logistics, payments. You have it's so easy to do it that the transformation is not going to be only on the financing piece. It's going to be absolutely on everything.
Money is a human construct. It essentially replaced information. Today, technology allows you to have more seamless information. So it's replacing money a little bit. That's the Industry 4.0. Industry 3.0 Capital replaced labor, robots replaced humans, Industry 4.0, information's replacing capital. It's actually a natural progression. It's just a continuum.
So will we lose all the paper? Notes, letters of credit, the whole thing?
No, I think there is already a good progress in terms of reducing the impact of papers, right? But it's not only coming from the bank. Let me give you an example. Probably you have read recently that there is a project initiative from Maersk, one of the most important shipping companies in the world, together with IBM, to completely remove and digitalize the entire process of shipping and removing entirely the papers, right? And this will, of course, will create efficiency in the logistic companies, but then, of course, that inevitably helps us also to remove the paper. Technology today, let me conclude that, forget about blockchain, but if you think about IoT, you ask if these technologies can help us to create new products and new services. Absolutely. With IoT, for example, you will be able to track the merchandise, but if you track the merchandise, means that you can also have a completely new concept of inventory financing, collateral management, prediction of defaults. You can try to help the companies to lower the premium that they have to pay the insurances because the potential claims are reduced. So there is a huge array of services that you can provide nowadays that before were not even possible to be foreseen. And then if you really want to look forward, but not that far away, if you think in the end that you combine IoT, so machine to machine and blockchain, maybe a few years from now you can really execute machine to machine payment, and that would be a completely new world.
Sadly, we've come to the end of a fascinating discussion. I think definitely we could have kept going. Thank you to the audience for being with us, and thank you, gentlemen, for being here. Thank you so much. Thank you.